We can talk about loan types. We can talk about zero down mortgages. We can talk about all that nonsense in the news. That equity position is why this is not 2008. That is why we are in a different environment. That is why we are not going to have a housing crash bubble, because there's $17 trillion in net equity sitting in the American households right now, to the tune of where the average American has an average equity position of $182,000. Welcome back to the What's More podcast. I'm your host, Quinton Harris. You are dialed in for episode 170. Pretty excited about this episode. It's kind of like I woke up this morning. I was like, man, we get CPI data. We get the Federal Reserve notes in the afternoon. This is the call for all nerds unite here, because it's just a data-filled day. But before I get started, I want to say to all the fathers, all the dads, including my dad, everyone that listens to this show, hey, happy Father's Day this weekend. I hope you guys have a wonderful Father's Day weekend. Charlie, happy Father's Day to you, my producer over there. I hope you have a great Father's Day weekend. And I hope you guys get a chance to celebrate that with all your loved ones. So let's dial into the show here. It's interesting because I kind of talk a little bit about some of the stuff we see online and some of the headlines, if you may. And as I'm working with more friends, family, colleagues, it's really overwhelming to see some of the stuff that comes out online. And one of the things that I'm seeing right now is just a lot of the same stuff, but kind of like restructured, maybe kind of repurposed, if you may, but it all has the same message. And that message can be skewed in multiple different directions here. One of the things I look at is that, yeah, we've got inflation data. We all keep up with it. We have to, right? Especially if you're in the industry. And if you're a consumer, you kind of feel like you know a lot about it right now because that's what people are talking about and the news talks about. But it all surrounds one thing. Like the Federal Reserve, which we're going to get later on this afternoon, and what are they going to do? There's probably a 99.9% chance it's another pause, right? And that we're going to get commentary that kind of leads us to believe that the cut is coming, right? But it's going to be the pause. And I've talked enough about the time we've sat down with Atlanta Fair Chairman Raphael Bostic and the commentary he gave us. But what you're seeing is multiple outlets now. And it doesn't matter where the outlet's coming from. It's almost like they're all coming out with the same thought process, but with different headlines, right? And so one of the things that I saw that was really interesting to me was that this home ownership, right? Home ownership equity is at an all-time high. And I'm going to pull up the article here as I'm talking about it because I think this is really important. Like, this is a thing right now. So there's this theology that if you bought a home somewhere in mid to late 22 or 23, you may not have the most favorable equity position. You have one, but maybe you're not locked in, right? You might have a rate with a 6 or a 7 handle on it, but you're not locked in. You're anxiously awaiting a lower rate environment so that you can make this jump, but your equity position may not be as great as someone, let's say, that bought in 2019, right? And for all the people that owned a home 2019 and prior, you're kind of like really in the you're in the equity zone, as I would call it, and you've really done well, right? And so one of the things that we were able to calculate with the help of CoreLogic, and we talked a little bit on our last real estate update with Daniel Halverson, but there's $17 trillion in home equity right now. That's what is considered to be like, I don't like the word tappable equity. So let me back up. Like, what I'm going to define as that is what we would call refinanceable or obtainable equity, right? That means that it's within the wheelhouse of loan parameters to get that money. Because the thing about equity, I was working with one of our interns here at the bank, and we were talking about this in part of our kind of like knowledge-based think tank concepts. Was I asked him, I said, hey, when you have equity in a home, whether you're a homeowner or your parents or a client, there's only 2 ways to get that. How do you get the equity? And the first thing he said was sell your home. And I'm like, yeah, that is one of the rules, right? The second one is you have to get a loan to get that equity, right? We just can't go say, hey, I want my equity. It comes with some sort of trade-off. And I was trying to explain this to him, but there's 2 ways to get that, is either through a cash out refinance or a home equity line. And as we've discussed, when you have a second lien, like a home equity line, that comes with a higher risk. Risk comes with a higher rate of return. And that's why the interest rate is so much higher on a second mortgage, because they're ultimately the second lien position on a property, and they don't have the ability to take over the first lien position or the rights of the first lien position. That's why you have that. But with $17 trillion of equity, man, think about what all can be done with $17 trillion. We've talked about the credit card conundrum here in America, and that just crested an all-new high last week. And so it's literally almost like 1.1 trillion at this point. So 17 trillion can do a lot of damage, almost wipe that out completely if all those people that have credit card debt necessarily own a home and have that. But there's a lot to be done with that. There also could be a lot of cash put on the sidelines, right? There's a lot of things that money could be used to potentially stimulate the economy, could be used to purchase other things, or it could provide a situation to where you sell your home, you get the equity, and you can put a larger down payment on another home, thus reducing the balance that you owe on that home. But there's a lot of things. It's just the options are kind of limited right now because of the higher interest rates, and that equity is sitting there. And this is a record high. This is really good news because most of the wealth of America, especially the net wealth inside of a household, is created by the equity in a home. So this is a good thing. But it poses the question, why is that happening, right? Why are we in such a, I guess you could say, restrictive territory with the Federal Reserve? How are home prices continuing to go up? And this is not an argument, but this is a debate that we have online all the time. You know, depending what YouTube channel you listen to, and I hope it's ours, by the way, at What's Your One More with the number one. If you're not subscribed, please dial into that. We'd love to have you on there because the comments and the debates that we have, they're great. But I do look at some of my competitors. We just had an influencer on the show a couple of weeks ago, and he said, hey, go to someone's channel that's doing it better than you, look at what they're doing, and then do it better, right? So we've done that before. But it seems like negativity sells, right? Doomsday sells. That's what's getting all the scrolls and all the likes. And so, but it's not necessarily true. It's not necessarily real. And I look at that and I'm like, is that because what people want to hear? Or is that because the people dialing into that show are in the same predicament as the message being delivered? I will probably venture to say it's that second one, right? I had an agent tell me the other day that buyers are just angry right now. They're just so mad. And I'm like, well, why are they mad? Well, because they're in an environment where there's this false expectation of reality that these sellers are wanting to sell their homes for the price of COVID levels, right? Meaning that, hey, listen, they're raising them much higher than they should be. But these buyers, they don't want to pay that. And they're angry. They're pissed off about it. And then you add in interest rates. They're angry, right? And my point is, well, are they angry because they missed the buy, or are they angry because the environment they're in right now just isn't giving them the window of opportunity, if you may? And I think that's the real question here, because if you've been trying to buy over the last 3-4 years and you missed out on multiple offers and you had to be locked into a rent, and now you come back out each year to go to the market and it's not working in your favor, I could see the frustration building. I could also say maybe there's another strategy you need to deploy to get that home. But the reality is there are angry buyers right now, right? And I think they're angry because of everything we just said, plus the fact that, hey, listen, I'm trying to get the home. I just can't get the home that I want for the price that I want to meet the needs of my household. Right? And I understand that. But it comes to this question right here. With all of the tightening that the Federal Reserve's do, we talked about that water spigot concept. For those that didn't tune into that episode, imagine a water spigot. That's the Federal Reserve. They're tightening the knob. And then the water that would come out would be the monetary supply. And they just tighten it completely. There's no drip. There's nothing coming out right now, right? And that's tightening of the cycle. But because of that tightening and because of what they're doing to reduce inflation, it's actually having the opposite effect on housing. And I thought this was interesting because this is an argument that maybe I don't think I looked at quite as well on the other side of the coin. And I appreciate some of the feedback online as well as some of the research we've done on this from our team over here. But the reality is this. Because of the tightening of the cycle and making the money supply so expensive, you have builders that are actually backing up in fear of maybe not being profitable in what they're building, but more importantly, maybe building something that's going to sit for a minute, right? So builders are not building at the rate they once were, thus shrinking the new supply market in many different markets, and that's creating less options for the buyers. And then because the rates are higher right now, you have sellers that are going, listen, either pay the price I want, which is probably more than what the market's going to bear, but they want it because they don't have to sell. That's that lock-in effect coming back in. They don't have to sell because they've got their budget at 2.5% to 5%, right? Somewhere in that range, that's where they have their mortgage rate, and their household budget is set at that, and they're very comfortable. But the expectation is, if you're willing, Mr. or Mrs. Buyer, to pay me this price that the home is maybe worth plus, right? If you're going to pay me that number, I'll move, right? But if you're not going to pay me that number, I don't need to sell, right? And so that concept, that ideology is also restricting the inventory levels. So whenever time we have a restrictive supply, right? The definition of inflation is too much money chasing too few of goods. That's the purest definition. If housing is restrictive because of those things I just mentioned, the actual opposite effect is happening. Those prices are going up, and you could argue they're going up prematurely. Like maybe they shouldn't be going up at this rate, but that is being caused by exactly what I'm saying, which is the tightening policy. So then it bodes the question of, well, hey, if they loosen that spigot and create more monetary, less restrictive territory and more supply for money, could that loosen up the housing supply? Well, I think the argument is this. I don't think prices of homes are going to come down until we get more supply. And I think that we can go on YouTube and you can look up doomsday. And you can have someone walk around with a camera and be like, oh my God, look, this home's for sale, that home's for sale, this home's for sale. That's great. That doesn't mean that, I mean, you picked a pocket, right? I can go to neighborhoods where there's no home for sale, right? Just as easy as I can go in there and pick out homes that are for sale. But until we get lots of more inventory, right? Right now, we need more inventory to the market to loosen up the price points, right? And until you get more supply, the prices aren't going to come down. Now, the argument could be as rates come down, which I've argued for, I think, 2 years on here, as rates come down, the price affordability gets better, but then it gets absorbed by the price point, meaning the sellers find this affordable mark and they start raising the price points, right? But that's a natural evolution that happens as rates get better. Right now, we're having this byproduct, this thing that shouldn't be happening because there's less inventory on the market. And if we were in a less restrictive territory, maybe you could argue more inventory would come to the market, which hopefully that is what happens here. But, as I kind of go through this here, I look at this and I say, today is such a big day at 2:30 at the podium because you're going to have Jerome Powell come on. And then we'll obviously follow up with our episode of the Jerome Powell Show. But that commentary that this gentleman's going to make today is vitally important because what we're looking for is this. What we're looking for is that, hey, listen, we continue to see the CPI and the PCE data improve. We're going to be watching the job market closely, right? I talked about the job market last episode on the BLS report. And as we dissected that a little bit more, I'll get into it here in just a second. But that's the things we're going to be looking at, right? All indications show that we are lining up for that one rate cut. And I'll go back to this statement too. We're in an election year. I think the Federal Reserve is politically aware, but they're not political. And what I mean by that is they're aware there's an election. Now, I don't think they sit in a room and they go, well, how do we keep this candidate in-house and how do we keep this one out, or how do we get this one in and get this one out? I don't think that's what they do. I think they say, hey, listen, what we don't want to be is a topic of debate at the moderated debate that they have, and we don't want to be the reason that these two are arguing about the economy. So what we did was we laid out a blueprint of what we're going to do this year. And inside of that was, hey, listen, we're going to have a rate cut, and we continue to update what we think is going to happen with that based on these factors, but we're not going to make this outlandish or this obscure decision during this time because we don't want to be the point of the argument at the podium there. So I think that bodes for this one rate cut that's going to happen throughout between now and the end of the year. And I think the market's anticipating that. But let me go back to those job reports. That's the only thing that could pivot that entire decision by the Federal Reserve is the job reports. If the job reports show signs of weakening. Now, by the way, they've done that. And they just did it again on Friday with the unemployment rate going up and the household survey being a negative 400,000 jobs lost. It was actually a little over that. Well, if you have the BLS report saying that, hey, listen, they created 252,000 jobs, but you had a negative 400,000 loss, that's a net negative loss, right? And that wasn't really explained well by the media, but that's the reality there, which is also why the unemployment rate went up. And my point with that is this. The Federal Reserve, they're seeing that. And I think that's going to get mentioned at the podium. And I think those are things that are going to happen. However, I just don't think there's enough decline in the inflationary numbers for them to go, yes, we're ready to start turning that spigot back on and more water coming out. But I will tell you this. Here's what's interesting to me in all of this. This equity position that the United States household is in. This is why we can talk about loan types. We can talk about zero down mortgages. We can talk about all that nonsense in the news. That equity position is why this is not 2008. That is why we are in a different environment. That is why we are not going to have a housing crash bubble, because there's $17 trillion in net equity sitting in the American household right now, to the tune of where the average American has an average equity position of $182,000. Again, I'll go back to, if you bought that home in 2022, late fourth quarter, 23, you might not be in that boat. You could be, but you might not be, right? But for those that had bought before then, you're probably well within that range and maybe even a little higher depending on the price point you bought at. That's a big difference between 2008 and 2009 because that wasn't the case. We were in a negative net equity position, meaning people owed more than the actual value of the property. And that's completely different than what we're at now. And that's why I kept saying you're chasing a ghost with these media headlines, because it's not there, right? I'll end with this. what's encouraging about this if I'm a homeowner, right? Maybe you're discouraged about the ability to list your price and get the home sold for what you want. Or maybe you're a future home buyer and you're going, listen, I'm angry, right? Maybe you're one of the angry people. Hey, that anger is about to subside. You're about to be in a position in the course of the next 6 months to where you can take advantage of that property you've been trying to get. The rates are going to be much more advantageous. I said on this show, and I think we said 5 is the new 3. I was talking with someone yesterday. I potentially think lower 6s could be the new 3s. And the reason I say that is because every loan right now is coming with an average set of discount points. So it's almost become the norm. By the time you add that on there, you're back into the 5s. And so I think that is the new mark to make this jump here. And I do think there's pent-up demand waiting. And I do think these angry buyers will become, let's say, happy homeowners over the course of the next 6 months to the year. And that's something I look forward to on this. And I think we're in a great position here. But if you guys like what you're hearing, please 5-star review this podcast, share it. We'd love to hear your comments. If you're not following us on YouTube, please do at What's Your One More with the number 1. Leave some comments. Now, the last show we were on, I talked about this. Hey, listen, by the end of August, we are going to start making someone's car payment every single month on this show. And I think the last one I ended with, hey, listen, give me your comments. Let me know. What do you think of this? Well, here's something that's interesting. Since that show, we've actually picked up a sponsor, and I'm very, very excited to announce who that sponsor is going to be next week. This is going to be something that's really cool. We're hoping to kind of help alleviate some of this economic pain that's out there, and I think this is a great way to do it. And matter of fact, I think we might be the only podcast that's actually giving our sponsorship money back to our audience. So this is exciting. I can't wait for that to kick off at the end of August. I can't wait to Zoom someone in on the show. Venmo, PayPal, pay your bill right there. I think this is super cool, and what a great thing to do to help people in some of the things that we're in right now, especially with this economic crunch. So again, if you like what you're hearing, 5-star review this podcast, check us out at YouTube, subscribe. If you haven't, go ahead and do it. That's the only way you're going to get into the contest. And we've got some other ways you can get some extra votes in there, but that's the main way to do it. That's where you have to start at What's Your One More with the number 1 on YouTube. Guys, till the next episode, we'll see you at 171 with my real estate counterpart, Daniel Halverson, as he cranks out a ridiculous lending update that's coming here. And if you haven't heard that, stick tuned. There's some great stuff in it. We'll see you at the next episode of What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.